Hi, it's Mo. Welcome back to the property vlog. On this week's video, what we've learned from raising and repaying over £5 million in private investment. Okay, so as I mentioned at the beginning of the video, we've raised and repaid over £5 million in private investment. So we've learnt quite a lot along the way, and I wanted to share 5 things to think about. Number 1, advertising. Number 2, gathering high-level investor requirements. Number 3, detailed investor requirements and documentation. Number 4, communication. And number 5, repayment. So to start with, on advertising, a bit of a cautionary tale. Now, you can't advertise for certain types of investment on social media because the FCA basically says unless you can confirm someone is either high net worth or sophisticated, you can't be sure that they'll understand the risk reward profile of the investment, and you could end up in court down the line with someone saying, well, I didn't understand the risk associated with an investment and it went belly up and I want my money back. So what are the definitions of high net worth and sophisticated? So according to the FCA, someone is high net worth if they have an income in excess of £300,000 a year, or they have net assets of more than £3 million. And someone is sophisticated if either they've been a director of a limited company that's turned over more than £1 million in the last 2 years, or they have made more than one investment in an unlisted company in the last 2 years. So this could be something like a crowdfunding investment. So the best thing to do to make sure you don't fall foul of these rules is just keep it really simple with your advertising on social media. Just talk about the credibility, talk about the deals that you're doing, talk about investors that you've worked with before. You don't have to talk about specific returns. You can talk about project returns, but not about specific investors that you've worked with or the returns they might have made. Just really try and build your credibility based on the deals that you've done. And then you can have specific conversations with investors when you understand whether they're high net worth or sophisticated. How we deal with this is we basically talk about the deals that we're doing, talk about how at a high level we work with some of our investors. Then when we can have a specific conversation with an investor to find out if they're high net worth or sophisticated, we'll then know whether we can speak to them about if they're high net worth and sophisticated, fixed interest rate deals, and also JV profit share type deals. And if they're not high net worth and they're not sophisticated, we will just talk to them about simple loan agreements. I'll link to my video on 7 ways to build your brand in property, and that will really help with the credibility part of getting investors. Number 2 is gathering high level requirements. So the best way to find out what an investor wants is to say to them, what's the most important thing to you in this investment? So for some people, it might be the level of security, it might be the interest rate, it might be the interest frequency, it might be exposure to you as the developer or as the investor, it might be some form of earn and learn arrangement, or it might be something else to do with the deal. And the only way you're going to know that is if you ask them what's the most important thing to them, and then you can really tailor the investment around both whether they're high net worth, sophisticated, and also what the most important thing to them is in the investment. Once you've understood at a high level what the investor is after with their investment, you can then move on to have a detailed conversation around the loan agreement itself, around the documentation, around security documentation, around the term, and things like that. This would include things like, what's the legal entity that's doing the investing? Is it a person? Is it a limited company? It might include things like, are there CT61 deductions due, where you have to deduct tax and pay it directly to HMRC and then they claim it back on their tax return. It will include things like, what's the duration of the loan? Are there any early repayment charges? So as the borrower, can you repay without penalty? And then number 4, communication. Communication's really important before the loan's begun, during the loan, and when the loan's been repaid as well. So you really want to make sure that you've got lines of communication open with your investors. At the very beginning, obviously you're communicating with them to understand what the requirements are, what they're looking to get out of the loan. Then you're drawing up the documentation. You want to keep in communication with them then. Then obviously you get the loan documentation signed and you get the investment sent to you. For the duration of the loan, you want to keep in communication. Now this can vary depending on the type of investment, and this could be you're providing regular updates on what you're doing with the money, what you're doing with the investment, whether it's a property deal or whatever the investment is for, you're providing updates on how that's doing. This is something we do with our profit share JV deals, where we'll provide written updates to our investors to let them know how the investment's going. In property, there are obviously sometimes delays with things, particularly if you're doing property development and maybe you're waiting for sales to go through or you're waiting for refinances to go through. And it's really important to stay in communication with your investors. If there is a situation where you think you're not going to be able to repay the loan by a certain date, it's really important that you have those conversations early so the investor can prepare, you can agree any kind of penalty terms, or you can agree a restructuring of the loan or an extension of terms. And it's just really, really important that you have that communication with them. You're open and honest about timelines, about challenges you're facing, what you're doing about it. If you just go quiet, they're obviously going to get really worried about how their investment is doing and whether they're going to get their money back. At the same time, if you're considering paying the money back early, it's also really important to have early communication with the investors, so you can tell them my intention is to pay the money back early on this date, and you can then have a conversation with them about whether they want to roll that investment into another scheme you might have, or whether they do want that money back early. And then finally, when you get to the stage of repaying the loan, you want to make sure you've got your documentation in place, you've got your loan repaid, you provided any documentation around any tax deductions that you've made, any CT61 deductions, and also that you get any charges that were associated with the loan removed once the loan is redeemed, and that can be done via your solicitor. So I hope you enjoyed this week's video. That was 5 things to think about when working with investors. If you are looking to learn more about how to invest with KHP, give me a shout. I'll put my details below. See you on next week's video.